So I felt bad that I gave you guys all this Roth IRA stuff, but let's pretend you're like me and you want to get started. So today's video is going to be how to pick what to invest in. ETFs explained simply. So today I'm just going to go over the easy ones. So we're going to do SCHG, SCHD, VU, and QQQ. If you're ready to invest but don't know what to pick, SCHD, VU, and QQQ, grow versus dividends, growth versus dividends. This video is going to make it stupidly simple. Look. Alright, so obviously you already know my spiel. I'm 22, I'm building long-term wealth, and you're joining me, so let's go. Alright, so an ETF is a basket of companies that you can invest in at once. So imagine we're buying a group of companies, and then SCHD is the name of that group. So you're buying SCHD, which means you're buying all those companies. So instead of picking one stock in that group and you're hoping it wins, you spread your risk across hundreds or maybe 500 if you have an index fund, for example. Examples of ETFs. So you got VU, tracks the top 500 US companies or the S&P 500. SCHD tracks dividend paying companies. SCHG is geared towards high growth tech focused companies. QQQ is much more zeroed in big tech, innovation, and heavier risk but bigger upside if tech is on the move. So how do you think about, or how do you pick which ones you're going to invest your $5 or whatever? So think of it this way. This is what I kind of think. Do I want safe, steady, long-term growth? You know, literally what Warren Buffett says. If you don't know who that guy is, he's basically a really blanking out value. He's a really good value investor, and he just says the typical person, all they need is to just track the 500 best companies and just put their money and forget it, set it and forget it. So if that sounds like you, VOO, VOO, that's a good ticker. So Warren Buffett always said VOO, which tracks the S&P 500, basically you're buying the whole US economy, so you can't fail. And it averages around 7% to 10% a year, so eventually you'll be fine. It's good for long term, set it and forget it. You know, if you buy just one thing, go ahead. If you want dividends or passive income, you got SCHD. These companies pay you cash just for holding them, and if you have them in the Roth, it's like a little small snowball avalanche, you know, it starts off small and then as it goes, it just grows into a bigger thing. If you have it in your taxable thing, your dividends are taxed, so be careful. So like I said, if you like the idea of income in the future, SCHD is solid, but if you're focused on trying to grow your money, you might want to lean towards growth. But you can have a portion of SCHD in your portfolio, it's fine. So now we've been talking about it. If you want higher growth, I'm gonna throw another one because I like it. VGT, SCHG, or QQQ. You can do your own research. Obviously, I want you to do your own research. Don't just follow me. I'm not a financial advisor, by the way. But these are tech heavy, more upside, more volatility, which means up and down a lot. Great if you're young and okay with market swings, which is what I just showed, market swings. So a simple portfolio example. If I was starting fresh out and didn't know what to do, you could do a balanced, here, actually no, I can't show it. Balanced portfolio would be 60% VU, 40% SCHD. Growth focus would be 70 SCHG and 30% VU. Tech heavy, 80% QQQ, 20% SCHD. Dividend focused, 70% SCHD, 30% VU. This is not financial advice. This is just what I would do. And, you know, you have to ultimately do your own research and base it upon what your goals are, you know, and research the ETFs. A lot of the growth ones are similar, but some have performed better than others, you know, like that's why it's up to you. If you're confused on what to invest in, pick a plan, be consistent, and let time do the work. Comment which ETF you're thinking about, and I'll reply, and subscribe if you're building wealth with me. And we're in this early, so don't worry if you start today or tomorrow. All right, peace.